Let's try that again. Rule number one, when you're on Zoom, make sure that you are unmuted. So good afternoon, everyone. It is Monday, and we are back with our Monday market updates. Hopefully everyone had an amazing holiday season. And of course, now it's back to reality. I can't believe it's already the 9th of January. And gosh, the weather here in Southern California, it's a little strange. I'll just say that. We were just outside talking about what we need to make sure to prepare for the big storms that are coming. But anyway, let's get back to our market update. And I'm going to share my screen and we will get going. Okay, so today, Monday Market Update. I'm Jennifer Tim. I am the owner of the Welcome Home Global Group. We are powered by Keller Williams, and we are really passionate about empowering you with information along your wealth building journey to make sure that you have all the right information at your fingertips so that, the right decisions at the right time. So rather than having a specific question, I thought I would just put our question marks out there for where are we, what is going on, because I know everything was a blur over the holidays as we were hopefully more focused on our families than what was happening in the real estate market. Let's start out with some national news. So one of the big things that happened in December was the Fed meeting. So these are some of the key takeaways. They definitely reiterated their commitment to higher rates. The next meeting happens right at the end of January. So I think it's the 31st over to the 1st of February. And the decision will then be made whether they go up 25 basis points or 50 basis points. So that's coming down the road. But let's have a look and see what they said based on the December one. So the Fed warns financial markets not to underestimate the central bank's resolve to bring down inflation, as minutes cite policymakers saying an unwarranted easing in financial conditions, especially if driven by a misperception by the public of the committee's reaction function, would complicate the committee's efforts to restore price stability. Excuse me. Risk of high inflation seen as the key factor shaping the outlook for policy, and staff economic outlook was less weak than in prior meetings. The staff sees the possibility of a recession as a plausible alternative to the baseline after previously viewing the odds at close to 50-50. So I didn't include a slide about the jobs numbers, but those came out more favorably than what the Fed were hoping. I know it sounds really strange, but they're really hoping to see an increase in unemployment tied to a slowing down of wage increases. So we've seen a little bit of wage increases slowing down, but the jobs are still looking fantastic. So the Feds are still concerned about what's going on with the economy. Let's have a look specifically in our real estate world and the big conversation that we've had in 2022, which promises to continue into 2023, is what on earth is going on with the mortgage rates. Now, remember that when the Feds amend those rates, the 10-year Treasury follows suit, and then that dictates typically what's going to happen with our mortgage rates. So if we have a look at our 30-year fixed rate mortgage, we started out 2022 at 3.47%. Remember those amazing days, buyers? And in October, we hit 7.37%, a significant increase. And that's settled down a little bit, and we've opened up this year at 6.5%. We'll have a look a little bit later at where some of the projections are, because so much of what's going to happen in the real estate world in this coming year is going to be determined by the pace of what's happening now during January. January indicators really help us understand what we're looking forward to in this year. Something that I do want to make sure that we re-emphasize again, that some of the situation that we're in with the lack of inventory, because we're going to talk about that over and over and over again, is actually something that predates the pandemic. It's something that we were working on and trying to find a resolution to well before we, knew about this thing called COVID. So we have more than a decade of underbuilding. So we're short of new construction. Inventory levels trending lower year after year. So homeowners have tended to stay in their homes longer to reinvest some of that equity into their homes. And of course, that was exacerbated during the pandemic when a lot of folks did re-look their homes and say, well, actually, I kind of like living here, but it would be even better if I updated the kitchen. And now that they've turned that equity around and put it back into their homes, they're staying a little longer. And then also remember that our largest pool of buyers ever historically are the millennials. And so we're seeing a surge in demand. So we've been sitting in this situation where we just don't have enough homes on the market for the number of buyers who are out there. And then we've had all this other, a global pandemic to deal with on top of that. So keep that in mind when you look at some of these numbers and look at the charts that we're going to look at. Total inventory of homes. So these are national numbers. Next week, we'll go back to looking at Orange County as a whole. I just really wanted to focus on nationally right now. So this graph, if you look along the bottom, you'll see that we have July and January. So these are years, July 2015, January 2016. So you'll see we always have a seasonality of properties, as we're in that getting towards that start of the year, we're really low. And then by the time we get to the middle of the year, we've got more inventory. Very typical, but as you can see, those inventory levels were ever decreasing. So that's why I made that point in the previous slide. So we have been going down historically for the last 10 years. Then, of course, we were hit with the pandemic, and then we saw some really strange things going on. And all the way down to the beginning of January 2020, 2022. So there's too many twos going on right now. And at that point, that's when we had those super low interest rates. And of course, that meant that there was a lot of institutional buying of properties. So that's that iBuyer greed. And then we came out, and this is where, obviously we don't have the numbers for January 23 yet, because we've just started the new year, but we're already way down on that inventory. So we came up for sure. So 67% more than January 2022, 39% less than January 2020. So we really need to see a good uptick in inventory to start the year off well, to know that we've got some recovery happening. And again, there's some projections. I have a really nice chart that we'll get to a little bit later, with those who have crystal balls are giving us their predictions of what's going to happen with sales. Demand. So the ratio is down. And what we are starting to see, and again, this is kind of, this is where we ended up the last week of 2022. Across the country, obviously, you've got a, we've got a deficit in the number of properties available to purchase. That has lowered the demand. The increase in the interest rates, a lot of buyers got basically, they can no longer afford to be in the market. In some areas, as we have here in Southern California, we're actually seeing demand is outpacing the level of new inventory coming onto the market. So our inventory keeps declining because the buyers are still there, definitely not as many, but yeah, we just don't have enough properties. So we can see that we are down when we look at these graphs. We're definitely down. And let's see if the buyer demand comes back. A lot of it is going to be based on where the interest rates end up. So talking of those mortgage rates, this is a great graph that shows you, here are our purchase demands. These are those peaks. When the rates are at the lowest, then the demand is at its highest. It makes sense because more people can afford to actually get into home ownership. Then when that starts reversing, which is where we are, there was our peak of over 7% in October of 2022, when the Feds basically shot everything up, and then the markets responded and our mortgage rates went up accordingly. Excuse me. And so we saw that demand and those mortgage rates going down. So you can definitely see the correlation between the two. The Fed's intent was to create more inventory by basically pushing those interest rates up, dropping down the buyer demand. But unfortunately, because we are so far behind in where we should be right now with how much inventory is out there, we haven't quite hit that median. Yes, we've lowered the demand, but the inventory has not gone up accordingly. List prices. So this is an indication of where initial median list prices are coming on the market. And rather than focusing on the dollar amount, because obviously in Southern California, if you were a buyer, you wish those were the prices that you were looking at. It's to really just look at where these trends are. And our list prices are down across the nation. And that gives us an idea of, basically that was an intent of the Feds as well, because we had a runaway rate of increase for those asking prices for homes. Because a couple of months ago, a seller could put it on the market, list it above where the last comp sold, have multiple offers, and then that would just create that bidding war that created higher sales prices. So, that has changed. That is a good thing, because that was definitely not sustainable. You can't sustain your growth, your list price growth of being over 20% every year. It just was never going to manage. So we do know that for example, in our Southern California market, we may see a rebound in list prices if the sales tendency of, that the sales are outpacing the new inventory that's coming on to replace those, then we could see those prices going up again. It's all about the inventory, not as much about the interest rates in some markets. Price reductions. So your normal price reduction that you see nationally is going to be that most listings will see a 30 to a 33% reduction in their prices once they've hit the market. We're actually starting out, here's your 40%. So we're definitely starting out higher than that, but that is starting to level off as sellers become more comfortable or just more in tune with what the market's doing at the moment, because buyers don't have to. There aren't as many buyers out there, and they certainly don't have to go to the moon and beyond with what they're offering to get into a property these days. Multiple offers are still happening. We're seeing in Southern California, and again, we'll look at those numbers in detail next week, but we're still seeing property selling around about 98% of list price. So it's still good. It's definitely not a crash by any means. But those properties that are languishing on the market have been rejected by buyers because those prices are too high. 9 times out of 10, based on the condition and the location of those homes, buyers are saying, forget it, I'll wait, or there's a better choice somewhere else. Rental rates. Now, this is an interesting one because, we definitely saw towards the middle of last year, because homes were just flying off the market, even though multiple offers, even though the prices were so unbelievably high. And at the same time, rentals were in hot demand. So those rental rates definitely went up at the same time. So rental rates and sales prices definitely move in tandem. As we're starting to see price reductions, we are seeing those rental rates go down. And we currently have a lease listing on the market. And that is a conversation that I've already had with the landlord, is that adjustment is going to need to happen because we haven't managed to get it leased yet, even though it's an amazing property. And even though there aren't as many rental units available, that's the situation that we're in. So here is our housing forecast. So these are different organizations, and they're giving us an idea of existing home sales, where they think we're going to go, prices, and that 30-year rate. So the top one is one of the big multiple listing services where agents list their properties. They believe that we're going to see a 6.4% decrease in the number of existing home sales. So this is not resale. This is resales, not new construction. They believe home prices will still see an appreciation, and that this 30-year mortgage rate is going to be around about 6%. National Association of Realtors, that's the next one. They believe we're going to see a 7% decrease in the number of resale sales happening, that home prices again will see a positive appreciation of 0.1%, and the 30-year fixed rate is going to end up at 5.8%. Freddie Mac definitely doesn't feel the same way, and they see a reduction of 12.1% in the number of sales. They see home prices actually decelerating and decreasing, and that the 30-year rate is 6.4%. Zillow believes that there's going to be a 13% drop in the number of home sales, that prices are going to drop 0.7%, and they didn't have a prediction on the rate. Realtor.com believes that home sales are going to drop by 14%. They do believe that home prices are going to go up by 5.4%, and the 30-year rate is going to be 7.1%. Redfin down 16% in home sales, down 4% in home prices, and the 30-year fixed rate at 5.8%. Fannie Mae is predicting a negative 21.1% in home sales. They did not have a prediction on home prices, and they believe that interest rate is going to end up at 6.3%. And I'm not going to look at the last one. Excuse me. So from this, you can see no one's crystal ball is particularly clear right now. We do know that just based on the indicators out there, that home sales are not going to be as strong as they were even in 2022. Fewer sellers are going to want to sell their homes. Home prices, if you sort of average those out, you're going to get somewhere along the sort of stagnant area. But it's going to be market specific. As I mentioned, in Southern California, we just don't have enough inventory coming on the market to replace what's being sold. And if that continues, then we will see prices inching up again. 30-year rate, general feeling out there is if we can end up the year, so we're sitting just over 6% right now, if we can end the year around about the 5.8, 5.9%, then we'll start seeing more home buyers coming back into the market, and we'll see, some of those properties that may be languishing are going to find a buyer as well. Now, again, just to sort of emphasize how it really depends on your perspective and who you are and where you are as to what you predict is going to happen. So Lawrence Yun, he's National Association of Realtors chief economist, with mortgage rates falling throughout December, which they did. They actually dropped down closer to 6%, and then they went up a little bit beginning in January. Home buying activity should inevitably rebound in the coming months and help economic growth. Whereas Doug Duncan, Fannie Mae's chief economist, said the economy caught its breath in the second half of 2022, but that doesn't change our expectation that it'll run out of air in early 2023 via a mild recession. So now again, just because that's what Doug Duncan says does not necessarily translate into a total 180 degree from what Lawrence Yun is saying, because we know that even in a recession, sales happen. So we will just have to wait and see. And that's the holding pattern that we're in right now. So much is going to depend on how many homes end up on the market in our local areas and nationally, so that we can see sort of where we're heading as far as the market is concerned. If sellers decide to hunker down again, as they did last year, towards the second half of last year, it's going to be a really tough market for buyers and sellers. As we always do, and I apologize for the cough, we're still trying to get rid of that virus that went through the family in December, and it's that lingering cough. So, as we've always said, it is so important to make sure that you are shopping around for a mortgage broker when you are ready to buy a home. And also, as a seller, it's important to understand what those interest rates are doing out there locally as well as nationally, because that does determine the buyer's sentiment and their approach to buying a home and their timing. So this is one of our lenders, Wells Fargo. They have some great options right now. Obviously, there are some discount points involved, but you'll see the contrast to one of the other mortgage brokers, so one of the private lenders. And it just reemphasizes again that it's really important to shop around. And of course, we would be honored to give you an introduction to a couple of different lenders so you can make the right choice for you. We are never, ever going to say you must use one lender over another. That is absolutely your consumer right to choose. So here's another one. As you can see, these rates quoted are close to the other ones, but it really depends on what you look like as a borrower in today's world. And in our newsletters, we often have hints and tips of how to make you look like a stronger borrower when you get to the point where you're ready to apply for a mortgage. So what is happening in some of our local cities? So we're going to start off with Dana Point and just show you what I mean when it comes to inventory and what we're seeing currently. So these reports come from Altus Research, and we pull the numbers on a Monday morning so that we have the latest, greatest. So in Dana Point, if we have a look, and I'm going to go straight down to inventory, here's our little graph of what we're seeing. We're down to 32 properties on the market in the general area of Dana Point, which includes Capistrano Beach as well. And this is for single family. So we only have 32 properties on the market, and our median list price is sitting at 3.397 million. Excuse me, our median days on market is 84. We are seeing an increase in the number of properties that are being rejected by buyers, and therefore they're seeing a price decrease. So that's a good thing, and that trend will continue. But again, when you look at the demand for a $3.3, almost $3.4 million home, that buyer pool is a lot smaller than you would see if we had a bigger range of properties. So slight seller's advantage in Dana Point. Laguna Beach, also a slight seller's advantage. Their inventory, they're down as well to 73 properties currently on the market. Of the properties still on the market, they are, 34% of them have had a price decrease. Interesting to see some of the price increases. And then their median list price is run about the 4 million. Their median days on market is 112. So we have seen that shift with our luxury market, that properties, especially if the seller is still thinking they could get what they could at the beginning of 2022, those property prices are being rejected by buyers, and those properties are going to stay on the market longer until the sellers do those price reductions, and then it's going to bring those buyers back in. There are still buyers out there. San Clemente, slight seller's advantage. Again, our median list price here is just under the 2 million. Our median days on market is 77. of those on the market, 47% have seen a price decrease, and our inventory is down to 66. Normally, we see a lot more properties on the market in San Clemente. This is definitely an area where, you know, that lack of inventory is driving that median price staying you know, relatively high. I mean, it's adjusted for sure, flattened a little bit, but not where maybe the Feds had hoped, and definitely not where buyers wish that they were. And then finally, San Juan Capistrano, strong sellers market. Median list price for homes coming onto the market is just under 2 million. And our median days on market is 49. So that's a strong seller's market. Those properties are not staying on long. Price decreases, 28% have had a price decrease, and our inventory is 25 homes. That's nothing to choose from. And again, you know, it really depends on the budget of buyers. But I know of a property in San Juan, just a small little condo, multiple offers. And that one has actually gone over the list price. Yeah, it's a strong seller's market. So just as a reminder, the services that we offer, so we are your local real estate planners. And think of us as like a financial planner. We're here to help you build and transfer wealth through real estate. So some of the tools that we offer: current portfolio analysis, current market analysis. As you've seen, we look at the national numbers, we look at Southern California, we look in Orange County, and then we look all the way down into the exact street where your property is. Because of course, if you have an ocean view property, that is going to have a different value to a property that does not. It'll be different depending on, honestly, you know, which school district you're in, which city you're in. There's so many factors that go into that. So we provide a current market analysis. We give you an idea of what the impact of interest rates is going to be on the pool of buyers who would be looking for a home like yours. We do an equity analysis. We have many homeowners who are sitting with a lot of equity in their homes because they've chosen not to sell, because we saw those crazy increases in values over the last couple of years, and you now have equity that you could do something with. We will help you with a capital gains tax assessment. We'll do an asset performance test and just see if you do have an investment property, how well that's performing. If you have a property that needs renovations or repairs, we help you with that analysis. Generational wealth building. For a lot of us, that's our goal. We want to be able to leave something for the future generation or somebody important in our lives, and we help you with strategies for that. Compounding value chart to make sure that you're making wise investments. And our favorite thing of all is the Family Feud Prevention Plan. And I'll just kind of summarize that in: you're going to leave one property to multiple family members. How are they going to divide that? Because houses can't quite be divided up. So we definitely help you with strategies to make sure that the legacy you're leaving doesn't end up with attorneys representing your kids or other loved ones fighting over what you have left with them with all the best intentions in the world. And then finally, that's our contact info. We would be so honored to sit down with you. So if you're considering selling a property this year, we would love to sit down with you, make sure that you're well prepared, that your property is positioned to make sure it sells in the shortest time possible for the highest dollar amount. Likewise, if you're a buyer, we're here to help you with the strategies. We have some buyers who won in a multiple offer situation, did not end up having to even offer the full list price, and all going well, their closing is happening tomorrow. So the buyers are still out there. This is a luxury home, and we can definitely help you with the strategies to get you through that process. And again, despite the holidays, this is a 30-day close of escrow, and we've managed to pull it together over the holidays. So we're here to help you. If you have any questions, please don't hesitate to reach out. We are so honored to be able to share information and help you make the best decisions. And we look forward to seeing you next week. And as I say, we will be diving a little deeper into what on earth has been going on over the holidays right here in Orange County.